Right, so today we will be covering what is top-down approach and welcome everyone. Myself, Srijit Kakar. Today is Thursday, 19th of March 2020. And like I already said, today's session would be top-down approach. We will be understanding what is top-down approach when it comes to trading. And before we move ahead with this session, let's get done with the formalities. So make sure you people pause the video and go through the disclosure, which talks about the representation, the risk disclosure, talks about the risk involved in the market, and also the copyrights. Now, before we move ahead, let me also add that these topics which I do are topics which you people are requesting for. So how can you request me if you're looking for a specific topic? All you need to do is just leave your topic in the comment section at the bottom of the video, and I'm noting down all these topics over a period of time. I'll be taking all these topics which I'm getting from you people. And yes, I would also like to add, if you're liking these sessions, make sure you hit the thumbs up button, share it with your friends, and let's get started with today's session, which is about top-down analysis. So when it comes to top-down analysis, you will see that generally top-down analysis is used for fundamental analysis. But it can be applied to both fundamental as well as technicals. But yes, by default, it's more like a more inclination towards fundamental analysis, where people they use this top-down analysis. So we'll talk about how people they use top-down analysis in fundamentals, and I'll also give you a few examples how it can also be done if you're following, let's say, technical analysis. So what happens in fundamental analysis? For the top-down analysis, we start with the global economy, right? So we try to understand what is happening all across the world. And once we have understood that, we move to the next step, which is local economy. So what I'll do is, as I move forward, I'll elaborate more on these, but let's understand these steps first. So you start with the global economy, which is the highest level. Then you go to a lower level, which is your local economy. Then you move to a specific sector. Then you look at different industries, and then you choose which specific business you would like to invest into out of those industries. So let's start with global economy. So what happens in global economy is that beginning at the global level may turn your focus on how majority of the economies across the world are doing. Are many economies in recession? Are they coming off from some, let's say, monthly highs or monthly lows? Has economic expansion been consistent, moving higher, or at least show sign of improvement? So that is what you try to understand globally, what is happening, first to understand where you should be starting from. Now, once you understand what is happening in the global economy, so let's take an example like we talked about. Let's imagine we are coming off from some monthly lows. So if you are coming up from some monthly lows, we know probably that things can start moving up. So when you're looking at, let's say, you can look at the world markets. That is what can give you that overall picture. So after you are done with the global economy, what you do is you move to your local economy. So what you do is, looking at the local economy would be analyzing a specific country or even specific region. So what can happen is you can look at, if you're participating in different countries, you can see which country would be more beneficial. Or let's say within your country, you can try to understand that, let's say, which part of the country, maybe the north or the south or maybe the east, which might be having. So an example can be, when it is summers. So in summers, we know that probably areas like where we have a lot of heat, probably that is where the sales of maybe air conditions can move up. So you can also be specific to a particular country, a particular area of that country, right? So that is what you try to understand in the local economy, that any specific country or specific region of a country, many times due to fluctuations in currencies, employment, government stimulus, taxation issues, different parts of those countries or different countries might be behaving different ways. So that is how from the global you move to that local economy. Then you look at sectors. So after having a look and narrowing down to local economy that is doing well, take a look at how specific sectors may be doing and their outlook. An example would be that when you're looking at sectors, maybe what you realize is maybe the technology sector is doing really nice. So now you know that we started from the global, we came to the local, and from that local economy, we can see maybe the technology sector is doing well. Then you'll move to the next level, which is the industry. That yes, we have the technology sector, but what industry is probably doing better in that technical sector? So an example can be that in the technology sector, it could be the application software. So once you know, okay, this is where maybe where I should be participating, then you can look at specific business, that which all businesses are in that application software industry. and let's say your example is Microsoft, and then you can start looking at opportunities on, as an example, Microsoft. So this is what happens in top-down analysis. People, they start with the global perspective, then they move to the local perspective, then they understand that in that local perspective what sectors are doing well, and in those sectors what industries, and in those industries what businesses are participating, and which business probably I should be investing in. Now this is how fundamental analysis works, but you can also apply something similar in technical analysis. One example can be, you can start with the global market. How's the global market doing, right? So let's say you're looking at the US market, right? That is where people, they generally take their cues from. How's the S&P 500 doing? How's the Dow Jones doing? How's the Nasdaq doing, right? Based on that, then you can see what is happening with our Nifty and bank, let's say the Sensex. And then you can try to see, okay, if Nifty is getting strong, or let's imagine if the Nifty is getting weak, which sectors are the strongest or which sectors are the weakest. And after that, you can go into what stocks are in that specific sector. So example, if you want to be a buyer, maybe you should be looking for a strong stock in a strong sector, right? If you want to be a seller, you can look for weak stocks in a weak sector. So that is one example. But now let's go into another example where I'll be talking about, maybe if you're just trading one single script, even on that one single script, you can do something which is more like top-down analysis. So what we can do in technicals is, again, this will vary from person to person, because different people might be using different methodologies to plan their trades or identify their trades. So I'll just give you one example. Now, based on your trading style or your trading methodology, you can try to incorporate something similar, maybe even into your, let's say, trade plan. So one example can be that, we have seen, because of Corona, the markets have been crashing like anything. So now probably we want to take advantage of these cheap prices. We want to buy things at some cheap prices. So what I can do is, as a top-down analysis, I can start with first the bigger time frame. So that first bigger time frame can be, in fact, we can use something which is called as multiple time frame analysis. So you can have a mix of different time frames. So in this example, I'll give you an example where I'm using 3 different time frames. The biggest time frame, and then somewhere in between, and then a lower time frame. So an example can be, let's imagine I want to do some investments. I can look at my bigger time frame, and let's assume my bigger time frame is a monthly chart. So what I'm trying to do now is, because I know that most of the stocks are beaten down badly, so now first I'll wait for some indications from these bigger time frames. What can be those indications? Depending upon your strategy, it can be different things. One example can be, maybe you're looking for companies or scripts which are trading below the lower Bollinger Band on the monthly time frame, right? Which is telling me now there is 96% probability it can go up. So that's one example. Maybe you're looking at Bollinger Bands. Another example can be, maybe you're looking at, let's say, some oscillators. Let's imagine RSI. So you're looking for scripts which are already below, let's say, 30, right? Which means they are oversold, and now maybe we are expecting them to correct or maybe start moving up. Third example can be, maybe you're using divergence. So you're waiting for positive divergence to show up, that because the prices have been moving down, let me wait for a positive divergence. Once I see that positive divergence, that is what is going to be my signal from the bigger time frame. So can you see, depending upon your strategy, it can be n number of things. I've just given you example of two, 3 things which can be used. So once you get that signal, now let's assume that I'm a person who's looking for divergence. So what is going to happen is, since I'm not trying to bottom fish, I'm not trying to catch the falling knife, first I want that I should be having some signal from a bigger time frame that maybe now the prices might start moving up. So for that, maybe I can use Bollinger Bands, or maybe I can use this, or maybe I can use this. It could be anything. So let's assume I'm a trader who is more inclined towards using the divergence. So I'll wait for a positive divergence. Now, once I see that positive divergence, now can you see what has happened is that from my top-down analysis, my biggest time frame, the monthly time frame, is telling me that yes, now we have positive divergence, maybe prices can start moving up. That is when I can look at the next time frame. So if I don't see that divergence on a script, probably I'm not trading that script. But if I find divergence on one specific script, probably that is what would interest me. Now, once I am done with the higher time frame or the bigger time frame, then I can move to the second time frame, which could be something in between. So like I said, this was the monthly. Let's imagine this is the weekly. So probably now what I want is that yes, prices were beaten badly. I have seen divergence. Now maybe from this time frame, I need something which can be more like maybe a moving average crossover, that I have a crossover which is telling me that yes, after that move to the downside, now prices have started moving up. Or it could be something like, okay, now I want to participate, I should be in an uptrend. So I'll be waiting for this time frame to confirm to me that the trend has changed to an uptrend. Another example can be something like that. Maybe on the weekly time frame we were having some area of resistance, and that area of resistance has been violated and prices have started moving up. So again, can you see what we are doing is we are doing top-down analysis. We are taking support from first a very big time frame, which is the monthly. Then I'm taking support from another time frame, which is the weekly. Now once I have that, let's assume the positive divergence, and let's assume now I can also see a moving average crossover. Then I'll move to my last time frame, which is where I'll be taking my trade. So in this example, let's take it as the third time frame. Let's assume that this was the daily chart for me. So once I know I have that positive divergence, right? I'm just taking one example. Plus I have also seen, let's imagine, moving average crossover. Now probably I want to be a buyer. So now I want to be a buyer. Let's assume that my methodology is that I buy based on let's say support and resistance. So what I'll be doing on the daily chart, now I'll be identifying support levels, and then I'll be waiting for prices to come back to those support levels and then taking the trade. Or let's imagine that I am somebody who's trading, let's say, chart patterns. So let's say I can see some double bottoms forming, and then we have that breakout of that maybe neckline, and then I want to participate. Or let's say if I'm using some Fibonacci levels, it could be Fibonacci's. So whatever your strategy is, can you see, every trader will probably be having a different strategy. But what you can see here is, again, we have done the top-down analysis. We have started with the bigger time frame to have a lot of probability stacked. Then we moved to another time frame to have more probability stacked, and then we took our trade from the lowest time frame, again based on certain strategies. So this is what we call as maybe top-down analysis. Generally it is called as multiple time frame analysis. But what is multiple time frame analysis? Multiple time frame analysis in a way is again your top-down analysis, where again you are looking at a script with different perspectives to understand. See, it's more like I'll give you an example. Let's say if you have let's say stomachache, and if you go to a doctor, what might happen is, generally you will see, doctors, they try to feel your tummy and try to understand what could be the problem. But then again, if they are not able to figure it out, or even if they are able to figure it out, they will tell you to get an X-ray done, or maybe to get a sonography done, or maybe to get a blood test done. So why are they doing that? They are doing exactly the same thing. They are looking at the same problem with different angles, which gives you a better clarity to what is happening and or what might happen. So that top-down analysis can also be done on script specific, and the way we do that is by using multiple time frame analysis. Now, even with demand and supply methodology, we use multiple time frame analysis. We use a minimum of 3 time frames, at times even 4, at times even 5. Now again, even in multiple time frame analysis, every time frame has a predefined purpose, and that is the reason we are using that specific time frame. So yes, this is what I wanted to cover today as a topic, which is top-down analysis, what happens in fundamental analysis, how you can even apply to technical analysis. I gave you a few examples, but like I said, it is going to be trader specific based on what methodology you're using, what you're more comfortable with. You will have to create a trade plan which helps you with the top-down analysis, even when it comes to your technical analysis kind of trading. So let's quickly look into what do we have in the chat box. If you have some questions, we'll quickly answer them, and then we'll end the session. And yes, I would also like to apologize. This Sunday I was not available. Otherwise, I also do a session on Sunday. So very good evening. Good to see you. Yes, Sunny, like I already said, I apologize. I was a little occupied this Sunday, was not able to take a session. How come you did not do your weekly analysis on Sunday? Was looking forward, right? Oral, again, I apologize. I already said that I was a little occupied. Because just to tell you the fact that the thing was, I had a friend who came from US, so we were partying pretty late till night, and that is why it was not possible for me to wake up early in the morning. So that's what actually the fact is. So the reason I was not able to do the session, because I was partying till late, due to which I was not able to do the session in the morning. But next Sunday definitely will be doing a session. So again, thank you so much for joining in. I will be seeing you very, very soon, and make sure whatever topics you want me to cover, put them in the comment section. I will be taking those topics one by one. So until we meet next, trade safe, enjoy your evening, take care, bye-bye.